It all starts with a vision, a project, a product, a service, something no one has done before. It's so simple, yet so powerful. Can you pull it off? Maybe. You and a mate are excited. You design a logo, create a name. It's all fun and games at first, but then you start shaping the concept and things get serious. You decide to turn this idea into a company. Now you need a structure, a legal structure. How much will this cost? In Australia, incorporating a company can range from a few $100s to a few thousand, depending on your needs. You'll need to cover registration fees and possibly legal fees, depending on how comprehensive your initial shareholder agreement is. Your incorporation costs are just the beginning. You also need to rent a server or find the tools to develop your product. So where does the money come from? At this early stage, it often comes from family, friends, or through crowdsourcing. Let's say your newly incorporated company issues 100,000 shares. You and your co-founder agree on 40,000 shares or 40% of the company, with a well-off family friend buying the remaining 20,000 shares for $50,000. This is your seed investment, setting your company's value at $250,000. If the company succeeds, your 40% share is worth $100,000. Not bad for a start. A year later, your product is in beta and customers are responding well. It's time to expand, hire a few people, rent office space, and move it beyond just the server. But that initial $50,000 only goes so far. Now it's a time for a bigger round of funding, a Series A round. In a Series A round, you're looking to raise, say, $1 million. You'll be approaching angel investors and venture capitalists, or VCs. People who invest in young, high potential companies like yours. They'll want to know everything: your team, your vision, what you already achieved, and where you're headed. Valuation is key in these discussions. You're talking about pre-money and post-money valuations. For example, if you're aiming for a post-money valuation of $8 million and seeking $1 million in investment, the investors would get a 12.5% stake in your company. After negotiating, let's say you secure $1.5 million from a combination of a VC and an angel investor, both agreeing to a $6 million post-money valuation. This means they now own 25% of your company. You and your co-founder's shares are diluted to 75%, but the value of your shares has increased. Raising capital doesn't stop with Series A. If your business continues to grow, you're likely to go through Series B, C, and even D rounds. Each time, the company issues new shares, raising more capital, but also diluting existing shares. Let's break it down. If your 100,000 shares represents 75% of the company after Series A, the company must now issue more shares to raise additional funds. This doesn't reduce your share count, but does change the total number of shares in the company. For example, after Series A, the total number of shares might increase to 133,000, with new investors holding the additional 32,000 shares. Your shares might now be worth $45 each, significantly increasing your personal wealth. Fast forward 6 years, your company has completed several investing rounds, launched a successful product, and turned its first profit. The big moment has arrived. Time for the exit. For investors, exiting means selling their shares, ideally at a significant profit. There are two common exit strategies: selling to a larger company or going public with an initial public offering, so an IPO. While founders often stay on to continue growing the business, the IPO route is where things get really exciting. Your company issues new shares to the public, and suddenly anyone can buy or sell your company's stocks. The value of your shares can fluctuate daily and your wealth could skyrocket. Imagine you floated your shares at $64 each and they surged to $70 on the first day of trading. Thanks to stock splits over the years, you now hold 10 million shares. That's a personal fortune of over $700 million. It's a far cry from when you were just two mates with a vision. It feels like just yesterday when you had nothing but an idea. Now you've built something truly remarkable. But remember, even after the IPO, this is just the beginning. With Amanda by your side, you can continue to grow and manage your business with the confidence that comes from real-time valuation insights. See you in the next video.